In this video, I'm explaining the concept of adjustments to final accounts. I'm going to divide this into two lessons, whereby in the first lesson, which is lesson one, in lesson one, I'm talking about the adjustments themselves, adjustments to final accounts. And these adjustments to final accounts include prepayments and accruals, bad and doubtful debts, depreciation. I'll cover these three adjustments. As I'm doing that, I will be illustrating to you how to really report these three adjustments in the statement of profit or loss of a sole trader and also in the statement of financial position. So after each and every adjustment, I will have to point to you where such adjustment is found in the statement of financial position and the statement of profit or loss, if it is an item of a statement of financial position or an item of the statement of profit or loss. Together with that, I have a question here for CPA May 2018, question number 1, which is about preparation of final accounts of a sole trader, and we shall be illustrating each adjustment with the additional information which you can see here in this particular question. There are very good additional information here which are touching on the various adjustments. So after each and every adjustment, we shall be looking at the relevant adjusting information in this particular question, so that we shall be developing workings for each and every additional information for this particular question from the adjustments that we shall be doing. That will form the lesson 1 of the adjustments to final accounts. And then in lesson 2, I'm going to provide a solution. The solution is going to be for this question of CPA May 2018, question number 1, which is about preparation of final accounts. So in that preparation of final account, I'm going to incorporate the various adjustments which you can see here in the additional information. And as we do that, we are going to prepare the statement of profit or loss and the statement of financial position to really then equip you with the knowledge and the skills you require to prepare the final accounts in whichever the situation you are in. Now, the two lessons, therefore, are coming as a package, because you need to understand lesson number 1 for you to be able to use it to answer a question in lesson number 2. Therefore, it is advisable that you really follow lesson 1, then you proceed to lesson 2, so that you really understand this particular concept very well. I'm starting with lesson number 1. Adjustments to final accounts. Adjustments to final accounts makes it possible for the preparer of financial statements or the preparer of final accounts to report on the statement of financial position, the appropriate assets, liabilities, and equity as at that date the statement of financial position is prepared. It also reports on the income statement or the statement of profit or loss, the revenues, proper revenues and expenses for the period. That is, having taken into consideration the revenues that are recorded in the period in which they are performed, and also expenses that are supposed to be recognized in the period in which they are incurred. In the first adjusting entry, we are going to talk about prepayments and accruals. And these prepayments and accruals are divided into deferrals and accruals. Under deferrals, we have prepaid expenses and also unearned revenue. whereby prepaid expenses are expenses paid in cash before they are used or consumed. And an earned revenue is cash which has been received before the organization performs in earning that particular revenue. So it is earned before performance, or so it is received before performance. And accruals, we have accrued revenue, and also we have accrued expenses. Accrued revenue are revenue for services which have been performed, but the income has not yet been received. So it is recorded before cash is received. Accrued expenses are expenses incurred already, but not yet paid for. Let us begin with prepaid expenses. Prepaid expenses are paid for and recorded before the company uses them. So cash payment takes place first before the expenses are incurred. In this case, therefore, the prepaid expenses are usually assets. These are assets. They are assets in the statement of financial position. So the items which are usually commonly prepaid include insurance, supplies, advertising, rent, and sometimes buildings and equipment. In a case that an expense has been prepaid, then this should be recognized both in the income statement and also in the statement of financial position. In the income statement, prepaid expenses should be deducted from the total payment. Deducted from total payment for that expense. That is in the statement of profit or loss. That is in the statement of profit or loss. But in the statement of financial position, prepaid expenses are supposed to be assets. But in the statement of financial position, prepaid expenses are current assets. Current assets in statement of financial position. In the statement of financial position. Let us therefore look at where they appear in the two formats. This is a prepaid expense. So under operating expenses, the prepaid expenses are recorded by deducting the amount prepaid from the total payment. But then in the statement of financial position, prepaid expenses are recorded under the current assets. As you can see here, this item called prepayments. This is a prepaid expense. Prepayments. That is a prepaid expenses. That is to mean the firm has already paid for the expense, but has not yet used it. Let us look at our illustration question to understand prepaid expenses. In the additional information number 2 in the question, it reads that as at 31st March 2018, 32,000 had been prepaid for insurance, while 4,100 was going for general expenses. Those are prepayments. Let us look at insurance. The amount paid for insurance is a total of 154,000, and we're told that 32,000 was a prepayment. That therefore means that if we want to determine the insurance for purposes of recognition in the statement of profit or loss, then the expense, insurance expense in the statement of profit or loss is going to be insurance expense. So the insurance expense is going to be the amount paid is 154,000. The amount prepaid is 32,000. Right, so then we are going to have the difference, because prepayments, we deduct them from the total amounts paid to determine the expense in the statement of profit or loss. So the expense for that particular purpose is going to be 122,000. 122,000. Now, 122,000 goes to the statement of profit or loss. The prepaid amount, which is 32,000, goes to the statement of financial position. As current assets, goes to the statement of financial position as current assets. That is for prepayments, and in this case, we have illustrated prepaid insurance. The next one is prepaid general expenses. And if you look at the general expenses here, the amount paid for that was 67,800. So general expenses. For general expenses, the amount paid during that period is 67,800. The amount prepaid during that period is 4,100. That therefore means that the expense of general expenses, the expense for general expenses is 63,700. 63,700. And that is the amount that should now be reported in the statement of profit or loss as operating expense. And in the statement of financial position, what we report is 4,100, which is the amount for prepayment. This is the amount for prepayment. So generally, we note that prepayment should be deducted from the amounts which have already been paid in the statement of profit or loss to determine the expense which should be reported for that period. And the amount of prepayment itself should be reported in the statement of financial position as current assets. The next adjusting entry is an earned revenue. An earned revenue. This is a situation whereby cash has been received for revenue, but the performance for earning that revenue by the organization has not been done. Therefore, that organization or the firm is now having a liability. They have not provided goods or services that they need to provide in exchange. So that is a liability. Therefore, an earned revenue is a liability in the statement of financial position. And an earned revenue, since the cash is received before earning the revenue, an earned revenue need to be deducted from the total amount of revenue received, or the total amount received for revenue. Usually, an earned revenue occurs most commonly in the following items: rent received in advance, air tickets charged in advance or received in advance, tuition fees received by a learning institution in advance, magazine subscriptions by customers in advance, and sometimes customer deposits when they are buying goods and services in future. In a situation we have an earned revenue in the statement of profit or loss, deduct the unearned revenue from revenue amount received for revenue. From amount received for revenue. That is in the statement of profit or loss. Then in the statement of financial position, unearned revenue are reported as current liabilities. are reported as current liabilities in the statement of financial position. The statement of financial position, they are reported as current liability. Let us see where that falls. In a situation we have an earned revenue, if let's say we have sales as revenue and there's some unearned sales, then we subtract them from the sales here. But then in the statement of financial position, an earned revenue will be reported as here, as current liabilities. So you can see under current liabilities, there is advance incomes. These are incomes received in advance. That is the unearned revenue and reported as current liabilities in the statement of financial position. The next adjusting entry is accrued expenses. Accrued expenses. Accrued expenses are expenses incurred already, but not yet paid for. Cash has not been paid for such expenses, but they have been incurred. In this case, therefore, expenses are recorded before cash payment. Usually, since we have incurred expense and therefore we are owing cash to another person, or we are owing services to another person, that is an obligation, and therefore accrued expenses are liabilities in the statement of profit or loss. Let us therefore look at the common situations where accrued expenses exist is a case of rent payable, interest payable, taxes payable, and salaries payable. Those may be examples. In case of accrued expenses, then accrued expenses should be added. Accrued expenses should be added to amounts already paid. Amounts already paid for such expenses in the statement of profit or loss. Remember, we have incurred expenses, some we have paid for, some not yet paid for. So the one we have paid for, we add the one we have not paid for. And accrued expenses are also current liabilities in the statement of financial position. Therefore, if you look at the statement of financial position, you will find accrued expenses under current liabilities here. That is where they are found in the statement of financial position. But when reporting expenses in the statement of profit or loss, then we need to add the amount already paid and the amount not yet paid, which is the accrued expenses. The next one is let us illustrate this using example in our illustration question. Additional information number 1, saying that only 10-month salaries are shown in the trial balance. That means out of the 12 months in 1 year, only 10 months have been shown here, meaning 2 months have not been shown here. So maybe they have not been shown because they have not been paid. We can assume those are accruals. So let us see how we're going to deal with it. We are told that an equal amount is paid for salary each and every month of the year. So salary is paid equally. And therefore, what we're going to do is to look at the amount already paid, which is equal to $1,080,000. So 1,080,000 is for 10 months. Therefore, we're going to say for salaries, salaries, 1,080,000 for salaries per month. Salaries per month is going to be 1,080,000 divided by 10 months. So that per month salary is going to be 108,000. Now already paid salary is equal to 1,080,000. Salary accrued, not yet paid. Accrued is 108 multiplied by 2, and that is going to be 216,000. That is not yet paid. So we need to add the two so that we're going to get a total of 1,296,000. 1,296,000 is the expense which should be recorded in the statement of profit or loss. Therefore, the statement of profit or loss, we're going to have 1,296,000, and in the statement of financial position, we're going to have 216. The statement of financial position, 216 as accrued expense, which is going to the current liabilities, these current liabilities. After that, the next adjusting entry is accrued revenue. Accrued revenue. These are revenue which have been earned. Revenue has been earned, but cash has not yet been received for such earning. The income has been earned already, but has not been received. Therefore, there is a recording of the revenue takes place before cash is received. In such a case, in statement of financial position, we are supposed to record a receivable of accrued revenue. And this receivable is recorded under current assets. Current assets. We record a receivable of accrued revenue under current assets. So that is why in the statement of financial position, there is accrued incomes here. The next adjustment is about bad and doubtful debt. Bad and doubtful debt. When talking about bad debts are debts which are irrecoverable. Irrecoverable. This is to say, you sold goods on credit and a customer is unwilling to pay. Unwilling customer. So the customer is unwilling to pay the debt. Or a customer may be unable to pay the debt. And a customer may be unable to pay the debt where they are declared bankrupt or they are facing financial difficulties. In that case, then, the logical thing for the business to do is to write off the bad debts. So bad debts may be written off because the customer is unable to pay them or unwilling to pay them, and the business is not in a position to recover such debts. So they are written off. They are written off. When bad debts are written off, they are reported as expenses. Bad debts written off are expenses. And they are expenses in the statement of profit or loss. the bad debts written off are also netted from receivables in the statement of financial position. So they need to be deducted from receivables, from accounts receivables. And they're deducted from account receivables in the statement of financial position. Therefore, in the various statements that we have, starting with the statement of profit or loss, bad debts are reported here under the operating expenses as one of the expenses if bad debts have been written off. And the bad debts having been written off need to be deducted from the receivables. Accounts receivable here will less bad debts, subtract bad debts, which have been written off. Let us look at the example in the illustration question that we have been using. Looking at the additional information, number 5. We're told that a customer owing 50,400 has been declared bankrupt. This amount is due to be written off in full. So just reading until that point is that a customer is owing 50,400 and this customer has been declared bankrupt, and therefore this amount is supposed to be written off. Once the amount has been written off, therefore, it will be reported as expense in the statement of profit or loss, and also deducted from the statement of financial position from the accounts receivable as at the end of the period. This is followed by doubtful debt. Doubtful debts are debts which may become bad. They may become bad. In a situation that the organization is of the opinion that some debts may become bad in future, a provision is made for them. A provision is made to recognize the fact that some debts may become bad. So the provision for bad debts, or also known as allowance for bad debts, is made. Now, this allowance for bad debts is to recognize the fact that even though we are reporting some profit today, that profit may not be a real profit when there is some debt which will not be recovered in future. And to recognize that, therefore, the allowance is created, and that allowance creates an expense in the statement of profit or loss, an expense known as increase in allowance for bad debts. Now, when there is an increase in the allowance for bad debts, then that increase is reported in the statement of profit or loss as an expense. Now, in the statement of profit or loss here, you can see we have an item here known as provision for bad debts. And this provision for bad debts should be increase in provision for bad debts. When there is an increase in provision for bad debts, then the increase is reported in the statement of profit or loss as an expense. So in the statement of profit or loss, we report the increase as an expense. In case of a decrease, in allowance for bad debts, the decrease is income in the statement of profit or loss. The decrease is income in the statement of profit or loss. Therefore, when we are looking at doubtful debts, then we are looking at an allowance which is created for debts which may become bad in future. And that allowance is an expense in the statement of profit or loss if it increases during the year, and an income in the statement of profit or loss if it decreases during the year. Therefore, decrease in allowance for doubtful debts should be reported in this category where we have other incomes, under other incomes. That is where it should be reported. Also, the balance of the provision at the end of the period, should be deducted. The balance at the end of the period should be deducted from the debtors, should be deducted from the accounts receivable in statements of financial position. In statement of financial position. Therefore, when we report the debtors in the statement of financial position, we also need to deduct allowance for bad debts. Also need to be deducted from accounts receivable. Let us focus on the illustration question, and we're still reading additional information number 5. Additional information number 5 reads that a customer owing 50,400 has been declared bankrupt. This amount is to be written off in full. An allowance for receivables is to be maintained at 3% of the remaining trade receivables. Now, trade receivables for this year is 1,101,400. 1,101,400. So we start with the trade receivables. Trade receivables equal to 1,101,400. Then from trade receivables, we need to less bad debts, the debts to be written off. So the debts which are supposed to be written off is 50,400. Now, in this trial balance, there is another debt which is irrecoverable, and you can see it here. But this one we don't subtract because already it has been deducted. That is why you find it in the trial balance. That is to mean that its account was made, and in preparing its account, a credit entry was already made in the debtors account, and therefore debtors have already been adjusted for it. So then we have this. We subtract the amount to be written off from the account receivables. Then we remain with the debtors, which now will be 1,051,000. 1,051,000. Now, to determine allowance for doubtful debts, then the allowance for doubtful debts will be equal to 3% of 1,051,000. 3% of 1,051,000. Now, 3% of 1,051,000 equal to 31,000. 31,530. 31,530. And now, after determining that, we need to check. At the beginning of this period, that is on 1st April 2017, the allowance for receivables was equal to 31,530. And now we have also calculated that at the end of the period, the allowance should be 31,530. In that case, there is no increase in allowance for receivables, and there is no decrease in allowance for receivables. In that case, there is no income and there is no expense for allowance for receivables in the statement of profit or loss. But in the statement of profit or loss, therefore, we are going to deduct the allowance for receivables, which is 31,530. At the end of the period, we subtract it from the receivables in the statement of financial position, that is under the current assets. So that what we're going to remain with, that should be presented in the statement of financial position as the receivable should be equal to 1,019,000 1,019,470. That is now the receivables that should be presented as current assets in the statement of financial position. That is after we subtract 31,530 from 1,051,000. But when we go to the statement of profit or loss, the statement of profit or loss, we are going to present bad debts written off as $14,200 plus 50,400. And that should give us a total of 64,600. The two figures here, we are getting them from this bad debt which was recoverable and the bad debts for the firm which has been declared bankrupt. And that is how to account for the provision for bad debts and bad debts written off. So they should go to the statement of profit or loss. Statement of profit or loss. The next important adjustment is known as depreciation of non-current assets. Usually, when the non-current assets are being used in the business, then they lose value. Therefore, depreciation is loss in value of non-current assets. Loss in value of non-current assets when they are being used. When a non-current asset is acquired, then their cost, the cost of buying non-current assets is capital cost. Cost of non-current assets is capital in nature. Because it's capital in nature, therefore, it is not usually recognized as an expense in the year it has been incurred, but instead it is spread for a number of years. It is spread for a number of years that the asset is expected to be useful. The process of spreading this for the number of years is what is known as depreciation. So depreciation is spreading the cost of the assets. It spreads the cost to the number of years of use, meaning the useful life. It spreads it to the useful life. Now, in each and every year, therefore, the amount of expense of the capital cost, which is used as the asset is being used, is what is recognized through depreciation. So depreciation recognizes expense of non-current asset, which is used in each and every period. Is the expense of non-current asset used during the period. So that is why depreciation is important. But this is in case the non-current asset is a fixed asset and tangible. But there are some fixed assets which are the non-current assets which are not tangible. And this includes the non-current assets like goodwill, like copyright, and the others. For such, the capital cost is recognized through amortization and according to IFRS, through testing for impairment. But that is not a discussion for today. Let us just focus on depreciation. Causes of depreciation. Causes of depreciation. The reasons why an asset is expected to be losing value include the following. Number one, physical factors. Physical factors here include wear and tear. The assets may suffer physical damage and wear and tear. It may have rot and decay, may decay away or it may rot. Secondly, economic factors. And these include inadequacy, and obsolescence. When you say an asset is inadequate for a function, it means it has low value for that function. If it is adequate, it has high value for that function. So it loses value due to inadequacy. Also, obsolescence due to change of technology may cause loss in value of the asset. Next one is time factors. And time factors affect leasehold property or leasehold assets. Leasehold assets are those assets which are held in leases. The assets whose value for the farm reduces as the time of the lease reduces. For example, if an organization is leasing a building and they have paid a lump sum for the building, let's say for 20 years. As the years passes by, the amount or the value that they have in that building keeps on decreasing until when it is fully used up and they have to return the asset back to the owner. So what makes them lose value in that asset is passage of time. This is followed by depletion in value. Depletion in value usually affects mostly natural resources. Natural resources such as oil, such as minerals, which are exploited. So as they are being exploited, then they are getting depleted, and that is the basis for depreciating such non-current assets, which are natural resources, forest resources, oil, gas, and we have resources such as minerals. They lose value as they are being exploited during extraction. Right. Let us then look at methods of determining depreciation. The methods of determining depreciation include the following. We have straight line method, reducing balance method, sum of digits method, output method, or production method, And lastly, we have machine hour method. The most common methods which are used in accounting especially are straight line method and reducing balance method. So let us look at these methods one by one, beginning with the straight line method. Using the straight line method, annual depreciation is determined as the cost of the asset times rate of depreciation. So a constant rate of depreciation is applied on the cost of the asset to determine the depreciation for a given year or for a given period. Now, using this method, usually constant rate of depreciation is charged from one year to another. So constant amount of depreciation is charged each and every time, because it is just the cost times the rate. If the rate is the same, multiplied by the same cost, then the depreciation is the same throughout. Each and every period, depreciation is the same. An alternative method that can be used is a method that applies the useful life of the asset. And if we are applying the useful life of the asset, then we can say that annual depreciation equals to the cost of the asset minus the residual value of the asset, which can be also be known as the salvage value of the asset. This is divided by estimated useful life of the asset. Estimated useful life of the asset. And to illustrate this, let us adopt this example. A business buys a $2,000 MacBook that won't be useful after 5 years, and that its estimated salvage value is $500,000. Required, determine annual depreciation of the MacBook. To determine the annual depreciation of this MacBook, then we can use the formula that applies the estimated useful life of the asset, because we have been given the useful life of the asset. Therefore, we say annual depreciation equals to the cost minus residual value divided by estimated useful life. So the cost is $2,000. The residual value is $500, and estimated useful life is 5 years, meaning after these 5 years, it will not be useful. So meaning it will be useful for 5 years. This equals to $300 US. That is equal to $300 US. Back to our illustration question, let us calculate depreciation on the assets as follows. That is additional information number 7. Depreciation is charged as follows. Buildings, 4% on cost. Equipments, 25% on cost. Motor vehicles, 40% on reducing balance method. So this is reducing balance method. But the first and the second one are on cost, meaning straight line method. So if we are applying straight line method, then we're going to calculate depreciation for these assets as follows, starting with the buildings. So depreciation on buildings is equal to 4% on the cost of the buildings. And the cost of the buildings here, you can see the cost of the land and building is 3.4 million. But we are told in the additional information number 6 that as at March, the land was valued at 1 million. Meaning inside 3.4 million, building is 2.4 million, and land is 1 million. Land is 1 million, building is 2.4 million. So then we multiply 4% by 2.4 million. And that will give us 96,000. That is a depreciation on buildings. Then depreciation on equipment equals to 25% times the cost of the equipment. The cost of the equipment is 220,000. So multiply that by 220,000. And that will become 55,000. That is 55,000. That is how to determine depreciation using straight line method. Let us then go to reducing balance method, which is the second method. Using reducing balance method, a rate of depreciation is multiplied by the net book value of the asset. So to determine annual depreciation, is determined as the rate of depreciation is multiplied by net book value of the asset. Now, not the cost of the asset, but the net book value of the asset. The rate of depreciation times the net book value of the asset. And this net book value of the asset is determined as the cost of the asset minus accumulated depreciation. Accumulated depreciation at that particular time. That therefore means that if we want to determine the depreciation using the reducing balance method, then we're going to have depreciation to be, that is the annual depreciation, to be equal to the rate of depreciation, which is a percentage, times the cost of the asset minus accumulated depreciation. So that is how we determine depreciation using that method. Let us illustrate this using the example, our illustration question, which we have here. And we want to use the motor vehicles, which is depreciated at 40% reducing balance method. So we start with the cost of the motor vehicle, which is 260, and accumulated depreciation of motor vehicle at the beginning of the year is 132,500. We can therefore determine depreciation for that motor vehicle by saying that depreciation for the year is equal to the cost, the rate of depreciation, which is equal to 40%, times cost of the asset, which is 260,000. That is for this particular item, 260,000, and then the accumulated depreciation is 132,500. So that we subtract accumulated depreciation, which is 132,500. Now we're going to have We're going to have depreciation of 51,000. Depreciation is 51,000. Having calculated it that way, depreciation is 51,000. 51,000.